The U.S. is preparing financial sanctions on pro-Russian separatists in Ukraine as Secretary of State Antony Blinken heads to Europe to meet the Ukrainian leadership and his Russian counterpart, part of a show of diplomacy and pressure that Washington hopes will dissuade Russia from invading its neighbor, U.S. officials said. As pressure mounts for the U.S. and its European allies to take swift action to deter Russian escalation, the coming action against Ukrainian individuals rather than the Russian government underscores some of the administration's hesitation to go after Moscow directly, officials said. The U.S. and its allies hope for a diplomatic breakthrough after 4 rounds of talks last week failed to narrow the gap between Moscow and Western nations. The pending sanctions, which will freeze the assets of at least 4 individuals, could be announced as early as Thursday. They would be the latest in a string of actions under an executive order signed by President Biden last April that aim to punish individuals associated with Russia's foreign aggression. The State Department declined to comment. The Treasury Department didn't respond to a request for comment. An expanded version of this story appears on WSJ.com. Might Joe Biden's plummeting approval rating be good news for the stock market? This question is not as off the wall as it might otherwise appear. Not only have researchers discovered a correlation between the stock market and presidential approval ratings, with one major exception: that correlation is inverse. That would mean that what's bad politically for Biden could be good for Wall Street. Contrarians believe that extreme positions are, at a minimum, exaggerated, whether in politics or economics. That's why, a year ago, they were not inclined to believe Biden was the savior that many commentators assumed. By the same token, they now don't think he's the disaster that many believe. The notion that exaggerated political beliefs might have an impact on the stock market traces to work conducted by Ned Davis Research. The firm has found that, except for when the presidential approval rating is particularly low, there is an inverse relationship between it and the return of the Dow Jones Industrial Average. DJIA, minus 1.34% currently, according to the presidential approval tracker at 538.com, just 42.4% of Americans approve of the Biden's job performance, with 52.2% disapproving. This 42.4% approval rate sits almost precisely at the midpoint of the 35% to 50% range that historically has been associated with the best stock market performance. Why would a president's approval rating be inversely correlated with the stock market? One plausible theory is that a high approval rating is associated with unrealistic expectations, generally, not just politically but also in the market. It's not just Monday morning quarterbacking for me to point this out. Consider the contrarian interpretation I provided 1 year ago in reaction to the much higher approval rating Biden then enjoyed. Given the intense polarity in our country right now, it certainly seems plausible that Biden will have difficulty advancing his ambitious agenda. There is a non-political reason for disappointment as well, given that so much is riding on ending the pandemic, an outcome that is by no means assured to happen in 2021. Today, in contrast, many have an equally exaggerated, but opposite, view of the political and economic environment. This may very well set up the preconditions for surprises to be on the upside in the coming year. Mark Hulbert is a regular contributor to MarketWatch. His Hulbert Ratings tracks investment newsletters that pay a flat fee to be audited. He can be reached at mark@hulbertratings.com. More. Republicans may win not just House, but also Senate in midterm elections. Here are 2022 Senate races to watch also. Brace for a volatile 2022, but cling to this tech stalwart when the storm comes, says investment advisor. Shares of Intuitive Surgical Inc. ISRG, minus 0.25% fell more than 4% in the extended session Thursday after the healthcare company reported fourth-quarter earnings and sales slightly above expectations, but said the pandemic continues to lead to fewer procedures done with its main robotic surgical system. Intuitive said it earned $381 million, or $1.04 a share, in the quarter, compared with $365 million, or $1.01 a share, in the fourth quarter of 2020. Adjusted for one-time items, the company earned $1.30 a share. Sales rose 17% to $1.55 billion, the company said. Analysts polled by FactSet expected Intuitive to report an adjusted EPS of $1.28 a share on sales of $1.52 billion. During 2021, COVID-19 resurgences continued to impact Da Vinci procedure volumes, the company said in a statement. COVID-19 has had, and will likely continue to have, an adverse impact on the company's procedure volumes. Shares of Intuitive ended the regular trading day down 0.3%. Crude oil prices settled at their highest level since 2014 on Tuesday, with geopolitical tensions in focus after an attack on an Abu Dhabi oil facility. That's as Goldman Sachs warned that surprisingly large supply deficits could see Brent prices top $100 a barrel next year. The fact that the Houthis are now capable of setting off explosives at the Abu Dhabi oil facilities must be raising blood pressure on the NYMEX, Michael Lynch, president at Strategic Energy Economic Research, told MarketWatch. Iran-backed Houthi rebels from Yemen claimed responsibility for the attack on the oil facility in Abu Dhabi that killed 3 people on Monday and caused a fire at the capital of United Arab Emirates International Airport. The UAE is the world's 8th largest oil producer, and instability in the Gulf can spark concerns of supply shortages. The damage to the UAE oil facilities in Abu Dhabi is not significant in itself, but it raises the question of even more supply disruptions in the region in 2022, said Louise Dixon, senior oil markets analyst at Rystad Energy, in a Tuesday note. The attack raises the geopolitical risk in the region and may signal the Iran-US nuclear deal is off the table for the foreseeable future, she said. That would mean Iranian oil barrels are off the market, boosting demand for similar-grade crude originating elsewhere. Against that backdrop, West Texas Intermediate crude for February CLG 22, plus 2.37% delivery rose $1.61 or 1.9% to settle at $85.43 a barrel on the New York Mercantile Exchange, following a 6.2% gain last week, its fourth weekly rise in a row, according to Dow Jones market data. March Brent crude BRN00, plus 0.43% BRNH22, plus 0.43%, the global benchmark, added $1.03 or 1.2% to end at $87.51 a barrel on ICE Futures Europe, after last week's 5.3% weekly advance. Prices for both WTI and Brent crude marked their highest settlements since October 13, 2014, according to FactSet data. The settlements at multi-year highs for the major oil benchmarks underscore the bullish dynamics in the market and leave the path of least resistance clearly higher with a new upside measured move target of $105 a barrel for WTI, said Tyler Ritchie, co-editor at Sevens Report Research. The fading worries about Omicron, which never resulted in demand-crippling economic lockdowns in most major nations around the globe, paired with a lower global supply outlook for 2022 has reduced the expected size of a surplus this year, he told MarketWatch. That suggests lower than average stockpiles right now will not recover very quickly in the quarters ahead. Meanwhile, Goldman Sachs rolled out higher oil price forecasts, setting a 2023 Brent spot target of $105 a barrel in 2023, with 2022 headed for $96 a barrel, it said. Robust fundamentals have reversed last year's oil price meltdown, with the market remaining in a surprisingly large deficit as the Omicron demand hit is so far smaller than that of Delta EXC. China, said a team of commodity analysts led by Damian Kervelin, in a note dated Monday. And while the Chinese economy may be taking a hit from lockdowns due to its zero-COVID policy, Goldman estimates a 500,000 barrel per day hit in the first half of 2022, the bank sees that offset by strong demand in the final quarter of this year, gas-to-oil substitution and supply disappointments. Net, we expect inventory draws to narrow but persist through 1Q22, with the global surplus in 2Q22 smaller than seasonal at 0.4 MB/d, said Kervelin and the team. And by summer, OECD oil inventories will be at their lowest since 2000, along with a historic drop in spare capacity from oil cartel OPEC and its partners. At $85 per BBL, the market would remain at such critical levels, with insufficient buffers relative to demand and supply volatilities, through 2023, he said. Goldman's call is certainly helping oil, but also, their argument that some OPEC Plus members, notably Angola and Nigeria, won't meet their quotas, leaving markets tighter for longer, is gaining a lot of credibility, Sears Lynch said. Oil remained higher after the Organization of the Petroleum Exporting Countries, in its monthly report, left its forecast for 2022 growth in oil demand unchanged at 4.2 million barrels a day, estimating total global consumption at 100.8 million barrels a day. Separately, a monthly report from the Energy Information Administration forecast a rise in oil production from 7 major U.S. shale plays, by 104,000 barrels per day to 8.54 million barrels per day in February, compared with January, with output from the Permian leading the rise. The EIA will release its weekly U.S. petroleum supply report on Thursday, a day later than usual due to Monday's Martin Luther King, Jr. holiday. Elsewhere in the energy markets, March gasoline RBH 22, plus 1.20% rose 0.5% to $2.432 a gallon, after gaining 5.2% last week. February heating oil HOG 22, plus 2.08% rose 1.5% to $2.674 a gallon, up an 11th straight session to mark the longest winning streak since December 1989, and the highest front-month finish since September 2014. Natural gas futures, meanwhile, saw their February contract NGG22, plus 1.88% up 0.5% to settle at $4.283 per million British thermal unit. Prices rose 8.8% last week. Shares of UnitedHealth Group Inc. UNH, minus 1.64% rose 0.3% in pre-market trading Wednesday, after the health insurer reported fourth-quarter profit and revenue that rose above expectations and affirmed its full-year outlook. Net income increased to $4.07 billion, or $4.26 a share, from $2.21 billion, or $2.30 a share, in the year-ago period. Excluding non-recurring items, adjusted earnings per share came to $4.48, above the FactSet consensus of $4.30. Revenue grew 12.6% to $73.74 billion, topping the FactSet consensus of $72.98 billion, as premiums increased 13.8% to $57.55 billion. Operating costs rose 10.1% to $68.20 billion, with medical costs growing 14.4% to $48.16 billion. The company affirmed its 2022 guidance ranges for adjusted earnings per share of $21.10 to $21.60 and for revenue of $317 billion to $320 billion, which compares with the FactSet consensus for EPS of $21.63 and revenue of $316.8 billion. The stock has gained 8.6% over the past 3 months through Tuesday, while the SPDR Healthcare Select Sector ETF XLV, minus 1.40%, has tacked on 2.7%, and the Dow Jones Industrial Average DJIA, minus 1.51%, has slipped 0.3%.